Let's get to the closing bell exchange today. Joining us, Michael Zinn from UBS, New York's stock exchange trader Steve Grasso from Stuart Frankel, and our own Rick Santelli. Let's start with you, Steve. In terms of the price action we're seeing today, clearly a decent little bounce back. And in general, is it still trade fears that's driving the action? And are you still surprised that we're not seeing more sell-off given the trade fears?
Yeah, I think all of the above. I do believe it's still trade. I think that still will dictate the near-term motion in the markets, whether it's higher or lower. But if you look at past performance of every time we talk about trade, it's always a buy the dip opportunity. It's always load up, back up the truck. I haven't seen anything that makes me change my mind. The market right now is up 5 handles. I think we should probably be up more than this, because I do believe when you saw DACA today and you saw President Trump have a little more of a pragmatic approach to it, I think that's the same scenario that's going to take place when it comes to trade. I think that the congressmen on the Hill are going to tell him this trade issues could be a problem for us in midterm elections, and you'll see him soften his stance. Yeah, that's good for the overall market.
Just signed an executive order to keep families together at the border. So Michael Zinn, the Dow is the underperformer, but look at the Nasdaq today. Yeah. We have Facebook, I think, at record highs again, once again. The components yesterday, like Amazon and Netflix, were doing well, even when the market was selling off. So is that a place you still want to be?
I think you want to be there. I mean, I think that tech has been the driver this year, along with the Fed, and I think value investors have eschewed stocks and gone to the safe bet of a 2% T-bill yield. I agree with Steve. I think trade talk is mostly political theater. I'd say we are a captive audience, and it could get worse before it gets better. But these big macro setbacks have been buying opportunities. So the only thing I would say on tech is there's been the change from last year to this year has been much more emphasis on growth, and not just growth and profitability, but growth. Straight growth is really outperforming in tech.
How so? Where do you see that?
In other words, if you look at some of the companies you named, or the companies that don't have profit, just have 30-40% organic growth revenue, those are the ones either being bought, those are the ones that are being bid up and really highly rated.
Even though GDP is growing you don't have to look hard to find growth anymore, but still people are paying up big.
Right, because look how flat the yield curve is. We're at 35 bips. So the sustainability of GDP is a question. So maybe tech is the invasive species that is eating up all the other industries which aren't prospering. Yeah. And so tech is grabbing a lot of that growth.
Rick, Steve said just moments ago that all these trade fear days have been buying opportunities for equities. Are they selling opportunities for the Treasury market? Because clearly we saw yields bid down yesterday, but they're back up again today.
I would think so. As a matter of fact, not only, or even maybe as one of the main characters being trade. Listen, trade is a big deal because other countries' markets yesterday were routed, and I really think the contagion of that wasn't so much that investors in U.S. markets don't have confidence that trade will turn out not to be a negative in the markets, but I think they were responding more to the flows of overseas markets like China that were hit extremely hard. I personally look at interest rates, and if I wasn't aware of all the news, yesterday's the first day of this month, first day of June, we didn't settle at 290. If you round, we did. It was 289.8, and 3/4 of a basis point. My point is interest rates are just holding firm. The dollar index holding nice ground, still darn close to the 95 handle. I see nothing in those markets that would suggest that we're not going to have a good delivery on the final second quarter numbers, the first quarter numbers, not bad either. I think we're going to see a wave of growth, and I do think that the rest of the globe will be carried along, but not to the extent that they have thought to be participating in the past.
Yeah, Michael Zinn, do people really think it's over? Yes, the yield curve is flattening. Sure, cycles don't last forever. Yeah. But they're going to say, great, we got to 4% GDP, so I'm pulling out of the market. I'm on the sidelines. You can't, this isn't sustainable. It can't get.
Yeah, I mean, I think on the tech side, it's a bit priced for perfection, so that if you have a stumble, that could be the case. But I mean, the Fed, I think, is looking for 2020 to sort of, wrap things up. So I think we probably have another year and a half or so to go before we get more dicey.
I also believe that corporate tax cuts, we've talked about this, I think everyone thought it was front-loaded and discounted completely in the marketplace. I would say that that's not the case. It's still going to be a tailwind.
Look at
it's going to be a tailwind, exactly, for EPS, for growth, for revenues overall. And don't discount the opportunity for another tax cut that's hit on the individual side before midterm elections, and that'll spark the market even higher.
You think they're going to squeeze that through in the next couple months?
I think they're going to do, even if it's a headline risk, I would never discount anything from this administration to keep. This is President Trump's barometer of success. It used to be home ownership. Now it's the stock market value.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.